What if the market is about to do the exact opposite of what the crowd expects? Because right now, retail sentiment is turning increasingly bearish while institutions continue quietly positioning themselves around XRP, tokenized finance, and cross-border liquidity infrastructure. Over the past few days, we've seen XRP ETF momentum accelerating in Japan, new XRP Ledger AMM architecture upgrades, quiet ETF inflows stacking day after day, OCC pressure mounting around crypto banking access, and even renewed discussion around XRP as a bridge liquidity framework in future payment systems. Most people are staring at price candles. The bigger players appear to be watching infrastructure. And today, we're connecting all of it. None of this is financial advice and is for educational and entertainment purposes only. Always do your own research before investing in digital assets or financial markets. Welcome back to Ledger Pulse, where we break down the biggest shifts happening across XRP, crypto regulation, institutional finance, tokenization, and the future of the digital economy. If you've been following the signals beneath the surface, this episode is going to connect all the dots. One of the most interesting signals this week didn't come from price action, it came from sentiment. Santiment released new data showing traders increasingly leaning bearish across crypto markets. Historically, periods where retail sentiment becomes heavily pessimistic often precede relief rallies or unexpected reversals. Why? Because markets tend to punish consensus positioning. When everyone expects downside, liquidity usually forms in the opposite direction. That doesn't guarantee a rally tomorrow, but it does show something important. Fear is growing while institutional narratives are still expanding. And that divergence matters, because while retail traders panic over short-term volatility, major financial infrastructure conversations are continuing behind the scenes. Not slowing down, not disappearing, actually accelerating. Now let's talk about Japan. One of the biggest developments circulating this week involves growing speculation around XRP-related ETF expansion and institutional demand in Asian markets. Reports highlighted how Japan's cabinet previously approved financial reforms that could eventually support broader crypto investment products, including ETFs. And this matters for one reason. Japan is not a fringe market. It's one of the most regulated and institutionally conservative financial systems in the world. If XRP investment products continue gaining traction there, it changes perception globally. We're also seeing increasing discussion around pension capital exposure, institutional crypto rails, tokenized asset infrastructure, and regulated digital liquidity systems. That's where SBI Holdings keeps becoming important. SBI has spent years aligning itself with Ripple infrastructure and XRP-focused financial innovation. And if institutional products continue rolling out in Asia, XRP's role as a bridge asset becomes much harder for traditional finance to ignore, especially in cross-border settlement environments. Because the core idea hasn't changed. Move value faster, reduce trap liquidity, lower settlement friction. That narrative fits perfectly into where global finance is heading. Now here's where things get even more interesting. Yellow recently highlighted a major architectural evolution happening around the XRP Ledger ecosystem. The discussion centers around the new XRPL AMM framework and expanded liquidity capabilities tied to the XRPL EVM sidechain. This is a huge distinction. For years, critics argued that the XRPL lacked the flexibility of Ethereum-style DeFi ecosystems, but now that gap is shrinking. The new framework introduces advanced liquidity curve structures, concentrated liquidity functionality, improved capital efficiency, and expanded interoperability potential. In simple terms, the XRPL is evolving beyond basic payments infrastructure. It's moving toward becoming a broader financial liquidity layer. And the EVM sidechain matters because it creates compatibility opportunities with the wider Ethereum developer ecosystem. That means DeFi applications, tokenized assets, liquidity protocols, real-world asset markets, and institutional settlement rails can increasingly interact with the XRPL architecture. This is the type of development many retail traders overlook during sideways price action, but institutions pay attention to infrastructure upgrades, especially infrastructure that improves liquidity efficiency. Another signal flying under the radar right now is ETF flow behavior. Bank XRP pointed out that XRP-related investment flows have reportedly continued for nearly a month straight without interruption. Meanwhile, Bitcoin saw turbulence, Ethereum cooled off, and some altcoins completely stalled. Yet XRP inflows continued stacking. quietly. No euphoric headlines, no retail mania, no massive hype cycle, just accumulation. And historically, major market rotations often begin this way, not with explosive retail enthusiasm, but with slow institutional positioning before broader sentiment catches up. That's what makes this period so interesting. The market still feels uncertain, but infrastructure, regulation, liquidity systems, and institutional exposure conversations continue expanding underneath the surface. Now let's shift to the regulatory side. CoinDesk reported that the Digital Chamber is urging the OCC to defend crypto trust bank approvals, involving firms like Coinbase, Ripple, Circle, and BitGo. This is a major fight that most retail investors are barely watching, because this isn't just about one company. It's about whether crypto native financial infrastructure gets fully integrated into the regulated banking system. And if these trust structures continue surviving legal and political pressure, it opens the door for institutional custody expansion, tokenized settlement infrastructure, regulated stablecoin growth, and deeper digital asset integration into traditional finance. This is exactly why custody keeps becoming one of the most important sectors in crypto, because institutions don't just need assets, they need compliant infrastructure. And the companies being discussed here are building that infrastructure layer right now. Now let's address one of the more controversial discussions circulating online. A resurfaced paper co-authored by Federal Reserve Chairman Kevin Warsh discussed SDR systems, liquidity mechanisms, and cross-border payment structures involving bridge frameworks. Some online communities are now connecting those ideas back to XRP and modern liquidity architecture. To be clear, this does not mean XRP has officially been selected by central banks. There's a huge difference between speculation and confirmed adoption. But what is important is that the exact problems XRP was designed to solve are becoming increasingly relevant globally. Those problems include fragmented liquidity, slow international settlement, expensive correspondent banking, trapped nostro-vostro capital, and cross-border effects inefficiency. That's why discussions around interoperability and bridge liquidity continue surfacing, not because of conspiracy theories, but because global finance genuinely needs more efficient settlement infrastructure. We're also seeing political rhetoric around crypto change dramatically. Recent comments from President Trump emphasize maintaining American leadership in Bitcoin and digital assets. Whether people agree politically or not, one thing is obvious. Crypto has become geopolitically important. Nations now view blockchain infrastructure, stablecoins, tokenized assets, CBDCs, and digital liquidity systems as strategic financial technology. This is no longer a niche industry. It's becoming part of global economic competition. And that shift changes the long-term outlook for the entire sector. Because once governments begin competing over digital financial leadership, infrastructure development tends to accelerate quickly. Here's the part many traders still don't fully grasp. Markets move in phases. Retail usually focuses on price first. Institutions focus on infrastructure first. Right now, we're watching ETF frameworks expand, tokenization systems mature, crypto custody infrastructure evolve, liquidity rails improve, and cross-border settlement discussions intensify globally. That doesn't mean prices only go up from here. Volatility will continue, corrections will continue, and narratives will rotate. But the underlying infrastructure build-out is becoming harder to deny, especially around real-world assets, interoperable payment systems, tokenized finance, and on-chain liquidity architecture. This space is evolving from speculative trading into financial plumbing, and XRP keeps appearing in the middle of conversations involving liquidity efficiency, interoperability, and settlement optimization. That's why so many institutions continue paying attention even while retail sentiment swings emotionally day to day. So now the question becomes, what happens if the crowd stays bearish while institutions continue building underneath the surface? Because historically, some of the largest market moves begin when public sentiment is weakest. I'll be watching ETF developments, XRPL ecosystem upgrades, institutional liquidity expansion, crypto banking regulation, and tokenized finance adoption very closely. If you enjoyed this breakdown, drop a like, subscribe, and let me know in the comments. Do you think XRP's biggest move comes from speculation or from becoming part of the next generation of global financial infrastructure? Thanks for listening, and as always, watch the signals beneath the headlines. We'll catch you in the next one.